You guys, if you've been paying attention to the US housing market, you might have missed what's quietly happening behind the scenes. Blackstone, the financial giant worth over $1 trillion in assets, with a T, isn't just buying companies, they're buying neighborhoods, entire housing ecosystems, and they're doing it without most people even noticing. But why now? And what does this mean for the housing market and for anyone trying to understand where real estate is really headed? Well, stick around because some of this might surprise you. Blackstone's reach is massive. They have over 250,000 rental units across the Sunbelt cities like Texas, Georgia, and Florida. That might not sound huge in the grand scheme, but the influence is massive. Even owning less than 1% of housing in a city can shift rental markets, affect construction trends, and reshape local economies. So why are they coming back into buying homes right now? Well, that's a story with layers, and I'm going to unpack it in just a second. Much of what Blackstone owns are multifamily apartments, but they've also dipped into single-family homes, mobile home parks, and student housing. They aren't chasing malls or office buildings, the commercial stuff. They're chasing places people actually live. And the more you dig into their acquisitions, the more you start to notice patterns that most analysts completely overlook. Hang tight because I'm going to show you one of the clearest examples in just a second. All right, I'm going to butcher this, but take Stuyvesant Town, Peter Cooper Village in New York City. Blackstone bought over 11,000 units back in 2015. That's 30,000 people living in apartments that are rent stabilized. They tried to push market rates on some tenants, which led to lawsuits and regulatory pushback. Even a giant like Blackstone can't ignore the law or the court of public opinion, but they have enough assets that they can outweight anybody. And it's a perfect example of how timing and strategy can make or break a large-scale investment. Next, I'm going to show you how they're turning these challenges into a playbook for growth. Blackstone doesn't just sit on properties, they upgrade them. Think video intercoms, improved elevators, even adding new bedrooms to existing units. On paper, it sounds like a standard value-add strategy, but here's the kicker. The upgrades also create new revenue streams while keeping tenants just happy enough to avoid blowback. And that's where you start to see the genius and sometimes the controversy of their models. I'll explain why this matters in markets across the country in just a second. Their business model is deceptively simple. They make money through management fees, performance fees, and private capital pools, mostly available to accredited investors. Only a sliver of their $315 billion real estate portfolio is retail-facing. But even if they can't buy into their funds directly, the moves they make ripple across neighborhoods, rents, and investment timing. And this is where even casual observers can start connecting the dots. After the 2018 crash, Blackstone became the pioneer of single-family rentals. They scooped up distressed properties, consolidated them, spun out Invitation Homes, and later re-entered the market with Home Partners of America. Lease-to-own agreements followed, and today high borrowing costs make it harder for people to convert leases into homeownership. But watching those programs closely reveals patterns about supply constraints and rent pressure. Right now, their single-family portfolio, including Tricon Residential, contains roughly 58,000 properties with thousands more under construction. Buying existing homes often costs less than building new ones, which is why they're doing it. And as new housing permits drop, rents are poised to rise faster in certain areas. Blackstone isn't just building a portfolio, they're building influence. From affordable housing initiatives to government-subsidized units, they're quietly positioning themselves as a key player in the US housing crunch and even benefiting from it. And here's a little tip for you guys. If you want to track these subtle market signals, tools like Deal Watch can give you insights on inventory shifts, price reductions, and under-the-radar trends before they hit the news. If you're interested in learning more about that newsletter, it's completely free. There's a link down in the description below. The thing is, all of this shows that real estate isn't just about buying and selling. It's about scale, timing, and reading the levers of supply and demand that most people miss. Sunbelt cities, urban cores, coastal hubs, they're all being quietly shaped by these moves. And understanding these moves can change how you think about the market entirely. Just to put this in perspective, this isn't just me telling you what to do. This is my take on the patterns I see. And of course, you should always consult a professional before making any major purchase decisions. But if you're curious about where the opportunities are emerging and want a discreet way to stay ahead, check out the Deal Watch newsletter. The link is in the description below. Finally, the takeaway. Blackstone's strategy is shaping the US housing market quietly but profoundly. Their moves are revealing patterns that can teach anyone paying attention a lot about timing, leverage, and where the next pressure points might be. You guys, the real question is, are you watching closely enough to see the story before the headlines catch up? We'll see you on the next one. Bye.